Warren Buffett is one of the richest people on the planet with a net worth of over $100 billion. He's amassed his fortune by being one of the best investors on the planet through his company, Berkshire Hathaway. His investment selections include companies like Apple, Bank of America, American Express, and Coca-Cola. Many investors try to copy what Buffett has done and will often imitate his trades and every move he makes. But hold on, I've just said that you shouldn't invest like Warren Buffett. Why did I say that? Well, in order to explain, let me take you back through Buffett's life, show you what made him his wealth, and explain some of the lessons that he actually shares with normal investors, because they're pretty much the opposite of what he actually does to make his money. It will all make sense in the end. Let's rewind the clock. Born in Omaha, Nebraska in 1930, Warren Buffett gained an early interest in the stock market after visiting his father's stock brokerage and even managed to buy his first share at the ripe old age of 11. He was later quoted saying that up until that point, he'd bought his first share, he was just wasting his life. All right, Warren, calm down, please. He was said to have been fascinated by numbers and the stock market ever since his childhood days and was also always looking for ways to make money. He did everything from delivering papers, selling chewing gum, to even coming up with a scheme where he bought a pinball machine and installed it in a barber shop. That business eventually grew and he ended up selling it for $1,200 at the time. That's the equivalent of around $15,000 today. Not bad for someone still at school. Fast forward a few more years and this is where the story really gets interesting as Buffett starts to learn about how he would end up dominating the stock market in the years ahead. While studying at university, he's taught by legendary investor Benjamin Graham, often cited as the father of value investing and author of the famous work The Intelligent Investor. Graham is who Buffett would end up really being influenced the most by and would who also later go on to work for Graham too. Graham's philosophy with value investing is all about finding companies to buy whose intrinsic value is below what the market is currently valuing the stock at. He'd do this in many different ways, looking at their balance sheet, future cash flows, levels of debt, if they held any stock in other companies too, for example, and then from this position, make investments that were good value. So once the rest of the market caught up and realized that this company had so much good value, the share price over the long term would eventually closer match the real intrinsic value. Many investors today follow this philosophy, including many of the best professionals with proven track records, finding and waiting for companies who look like great value. Looking at Buffett's portfolio, you'll notice that he's held onto a lot of his investments for a long period of time, and each holding is worth a small fortune. However, when he initially made the investment, the companies were not necessarily doing amazingly well, and it was all about their long-term prospects. For example, one of his largest holdings in his Berkshire Hathaway portfolio is Coca-Cola, one of the world's all-time greatest brands. Buffett made his first investment in the company back in 1987 for $1 billion during a period of market decline. That was definitely a huge amount of money back then at the time. One of the reasons he loves his stock so much is not just because it can make healthy amounts of profit and pays a nice dividend, it's because of the power of the brand. Companies like Coca-Cola have a massive competitive edge because customers love their products. They can even raise their pricing and people will still buy the famous carbonated sugar water. Think about this too. They've not had to change the winning formula for more than a century. Oh, and guess what his investment in Coca-Cola is worth now? A staggering $23 billion. And it's his fourth largest holding. Sounds simple then. If you want to be like Warren Buffett, just buy companies who look cheap, find the ones that are undervalued, underloved, and wait for the right price to strike. And then most importantly, hold them for a super long period of time, but preferably a lifetime. All you have to do is read through thousands of financial statements, do loads of research into companies, and build up your own financial models so you know exactly when to buy and what price is right. Easy, right? Well, no. This is where what Warren Buffett does himself and what he actually advises people to do differ the most. The average investor is the average person. They've got a full-time job, a family, and plenty of other things to worry about than to spend their free time trawling through balance sheets and income statements. Buffett and his partner Charlie Munger are the opposite. They have all the time in the world to sit down to read and research, and it is in fact what they do for most of the time. Each year, Buffett and Munger write to all of their shareholders in the now infamous annual letter from Berkshire Hathaway. Over many decades, they've often noted that the average investor is far better off investing into low-cost index funds like the ones that hold the S&P 500 and sticking with it over the long term. They aren't stupid. They know that the results don't lie and the data is overwhelming in that low-cost index funds be actively managed funds most of the time over a long time period. And they also know how hard it is to pick winning stocks. In fact, rather than just saying to investors that they're much better off using an index fund and passively investing their money, Buffett is putting his money where his mouth is, and has actually instructed that upon his passing, 90% of his wealth will be thrown into the S&P 500. This isn't the first time either that he's made such a suggestion. He's been very consistent about acknowledging the power of the index fund. One of Buffett's greatest bets was when he put his money where his mouth was and made a wager with an active hedge fund manager that a passive fund could beat his hand-picked one over a decade. The bet was for $1 million. Buffett was confident it wasn't going to be smooth sailing. The bet took place just before the market crashed in 2008, and after the first year his index fund was down 37%, where the hand-picked fund only took a smaller dive of 23%. The hedge fund managers were laughing. They've got this one in the bag, surely. However, in the following years the index made a comeback and started to eat away at their gains. By 2016 the index gained over 11%, whereas the active fund struggled, and the end results spoke for themselves. Take a look at this. The index fund was up over 85%, where the closest managed fund was 62%, and the average was even worse. Not to mention the fact that during this time frame, hedge fund managers typically charge very handsome fees, often a structure of 2% and 20%. 2% to manage and 20% of the profits. Whereas passively managed funds charge massively lower fees, more like 0.04% or close to that amount. You'll be glad to know that the wager ended with a lot of money to charity. Buffett didn't take the winnings and go buy more shares in Coca-Cola shares, but the point still stands. What does this mean then for us, the average investor trying to make a win out of a big, bad world of the stock market? This reminds us that trying to beat the market is hard. Not just hard, really hard, especially over a long period of time, and doing it consistently. Anyone can pick a winning stock that does well for a year or two, and they can even do it randomly. This becomes even more true when you're in a bull market and seemingly every stock is going up. Anything with a pulse that promises to change the world and becomes the next Tesla gets investors' hearts racing and opens their wallets faster than the 0 to 60 time on the model Plaid. There's big money out there to encourage you to trade frequently and more often. The more you trade, the more commissions and fees that are generated by the various brokers and the market makers. The news media is constantly pumping out noise and reacts to every single whisper, analyst report and earnings call, trying to predict and make calls on a future that is entirely unpredictable. We all get swept up in the excitement to buy stocks that are apparently about to blow up, buy nearly at the top, and then when start to sell when panic happens, when things are heading in the wrong direction. It happens time and time again over many generations, over every single boom and every single bust cycle, and the winners are those with patience who detach themselves from emotion, turn off the noise and find the right moment to make their move. Does this mean that we shouldn't bother buying stocks then and just stick to index funds? Well, if you can do that, great. And that would be an amazing strategy, especially if you're not really interested in stocks. But then where's the fun, hey? If you actually enjoy the chase and you have a constant itch to make small but calculated bets, then why not? As long as you acknowledge and understand that you are fighting a battle that is very hard to win, and appreciate that there are countless unknown variables that you haven't even considered, which may affect your outcomes. Some of the best investors have this kind of mindset. They're humble, fully self-aware, and realize that they will make mistakes often. This is why for my own investing, I'm trying to get the best of both worlds. The core of my portfolio will remain in low-cost index funds. How much exactly in what proportion? I'm not entirely sure, but it will always have a prominent feature, maybe even the majority. Outside of this, I'll make my own calculated bets according to my own tolerance for risk in individual stocks and the world of cryptocurrency too. My goal is to grow my wealth in the long term, and if that's also something that resonates with you, taking the lessons of Warren Buffett might be something valuable to take on board. This video is a strange lesson of doing as I say and doing as I do when we think about back to how Buffett's grown Berkshire Hathaway with Charlie Munger into the giant it is today. They are amazing stock pickers, there is no doubt, but they also realize and appreciate the challenges of the business and the toll it takes to get there. For most people, picking stocks is just not worth it and not required by investors in the 21st century. It's not to say that you can't win, but just like the ball on the roulette runs around and bounces all over the place before settling inside a single number, nobody knows where it will land before it actually gets there. Can you get an edge on the house? Yeah, for sure, but can everyone? Absolutely not. So why not take yourself out of the casino games and own the entire casino? Hell, why not own the entire street and every business on it? That sounds like a much better path to success to me. Anyway, thanks for watching the video. I hope you had a great Christmas and I wish you an awesome start to 2022 if you're watching this in 2021. Like the video if you found it interesting, subscribe for many more if you aren't already. I'll see you guys in the next one, and as always, happy investing.